It was the slight and unexpected increase in South Africa's CPI, which was the main data event for local markets last week. March's inflation ticked up to 7.1% year on year, fanned by the increasing costs of insulating from load shedding and other domestic infrastructure failings, among other factors, with core inflation stabilizing at 5.2%. Now, all of this adds to the growing number of signals. The Reserve Bank is expected to continue hiking the repo rate at its May meeting by at least 25 basis points. And while we expect inflation to start unwinding, it won't be a quick drop off, as high electricity tariffs, as well as a recent rally in the price of oil, will keep the basket price elevated. A recent Capitec report shows just how much stress there is in the South African economy. The bank has noted an 80% increase in impairments totaling 6.3 billion rand. Despite a slippery slope of negative sentiments towards SA Inc., the repo expectation is adding to the rand's recovery efforts against the US dollar. The American greenback finds itself on the defensive as softer data calls into question whether the Fed will push for one last hike of 25 basis points or not. Last week's data from the US housing sector and retail sales, which contracted by 1% month on month, are all signs of the tighter monetary environment rippling through the American economy, and the evidence of an economic slowdown is growing by each passing day. Meanwhile, the EU core inflation reached a record high of 5.7% year on year in March. And taking this, together with last week's minutes from the ECB's latest policy meeting into account, there is strong evidence to suggest that the rate hike cycle still has some way to go for the bloc. Over in the UK, authorities are seemingly being pushed to remain hawkish. Tight labour conditions, coupled with a 5.9% private sector pay increase released last week, will counter the marginal decrease in March's inflation to 10.1%. That being said, we are expecting price pressures to moderate throughout quarter two as last year's energy price shocks begin to fall out of the annual comparisons. And it seems like everyone who had their fingers crossed for a China recovery has something to smile about. The country recorded its fastest growth pace in a year, exceeding expectations. Quarter one GDP figures released last week showed an uptick of 2.2% quarter on quarter and 4.5% year on year. And this proves China's recovery is on track following its comparatively late reopening from the COVID-induced lockdown. But there's two things to take note of, though, is that the effects of the normalization of the economy will wait in time, and two, Chinese factory output still needs to catch up as global demand remains dampened. And there's further evidence of this in the Japanese economy. With its export-focused economy, industrial output numbers released last week revealed a 0.5% contraction year on year in February. This is all evidence that global demand remains hushed. At last week's G7 meeting, leaders continued to straddle the difficult geopolitical relations. While it harshly condemned Russia, it took a much softer tone towards China, despite Hong Kong seemingly cozying up to Moscow while also pandering to Western leaders at the same time. It's all politicians politicking. But a new conflict has since grabbed the attention: Sudan. Once allies in the 2021 coup, the Rapid Support Forces paramilitary and the Sudanese army have launched a full-scale offensive against each other as the leaders at the helm of the respective groups want to hold power in the transition to civilian rule. Now, some experts are calling this the first steps in what could be a prolonged civil war, adding to the region's existing instability. There have also been reports of Russian support for the RSF paramilitary forces through the Wagner mercenary group, which, by the way, has been active in Sudan for many years. Taking a look at the week ahead, it's a thin liquidity week in South Africa, as Thursday's public holidays prompting many to take Friday off as well. Lucky. There are still several month-end publications coming out, but they're typically not market-moving publications. Among them is the SARB's leading indicator released on Monday, and we're expecting the data to reveal a further downturn in the South African economy, which then supports ETM's view that the country has already entered a technical recession in the first quarter of this year. Then on Tuesday, we're expecting March's PPI data to show a further slowdown from 12.2 to 11.5% year on year, as fuel inflation in particular falls off sharply due to the comparison against last year's high base. Then on Friday, South Africa will post the trade balance for March. And while there was a rebound in February from a deficit to a 16 billion rand surplus, it's unlikely that this trend continued, as imports were dragged by lower mineral imports and subdued local demand. The consensus view is that last month's trade balance have widened again. America's quarter one GDP figures are set to take center stage this week on the international data front. And according to Bloomberg, most expect a 2% growth rate quarter on quarter, which is a slight pullback from the 2.6% noted at the end of last year. Now, although this is still a healthy expansion, as mentioned earlier, the outlook for the world's largest economy is not all that rosy, with the cracks from the tight monetary environment really starting to show. And if there is a surprise in Thursday's print, there will certainly be some fresh price action. The Eurozone is also set to publish its quarter one GDP figures this week on Friday, with the consensus expecting a slight slowdown from 1.8 to 1.3%. And if realized, it will be the bloc's weakest growth rate in 2 years. Now, given all the headwinds, we believe there's a relatively strong probability that the EU will tip into a recession within the next year, particularly if the central bank keeps its foot on the tightening pedal. Also happening on Friday, the world's most accommodative central bank, the Bank of Japan, is expected to stay put on its repo rate in the wake of the uncertain global macro outlook. Before we get to what to expect from the Rand this week, Eskom's former head, Andre de Ruyter's appearance before Parliament's financial watchdog this week is set to dominate the news cycle. He has been asked to flesh out the allegations he made about senior ANC politicians' involvement in the mass-scale corruption which has crippled the utility and left millions of South Africans swearing in the dark. Turning to the local currency now, after rallying over the last 2 weeks, the Rand retreated against most of the major currencies going into the weekend. And given the lack in positive prospects for the South African economy, any bullish projections are linked to other currencies facing a weaker outlook, which is something we're only expecting to really see in the second half of the year. This week's holiday disruptions will have local investors taking their cue from economic data releases, though, which will provide a clearer direction going into next week. And should this week's releases serve up any surprises, the Rand's response could be significant. That then the week that was and the week to come for the markets.